Welcome back to the Business Leaders of America podcast, where business leaders come to share their advice and journeys to success with existing and emerging leaders of America. Now, here's your host, Dylan Bloyd.
Hello, everyone, and welcome back to the Business Leaders of America podcast. Today, I'm joined by Richard McWhorter, Managing Partner and Private Wealth Advisor at SRM Private Wealth. Richard has spent more than 3 decades advising high net worth and ultra high net worth individuals and families, helping them navigate the complexities of wealth, legacy planning, and long-term financial strategy. Today, he and his team oversee roughly $1.8 billion in assets, working with entrepreneurs, executives, athletes, and entertainers who rely on his holistic approach to managing and preserving wealth across generations. Before co-founding SRM Private Wealth, Richard held leadership roles at some of the largest institutions in the financial industry, including Merrill, Lynch, and Barney. Over the course of his career, he has built a reputation for helping successful individuals make thoughtful decisions not only about their investments, but their families, their values, and the legacy they want to leave behind. In this episode, we'll talk about what it takes to manage wealth at the highest levels, some of the common financial mistakes people make during major liquidity events, and how families can align around values across generations. Richard, welcome to the show.
Hey, thank you for having me today, Dylan.
Yes, absolutely. Richard, so you've spent more than 3 decades in wealth management and now oversee about, $1.8 billion for high net worth and ultra high net worth clients. To start, can you take us back to the beginning? What first drew you into the world of finance and wealth management?
First of all, when you start off with 3 decades, it just makes me sound so old at this point. So I got an internship when I was 17 years old. I was just starting college and got an internship at a company called Dean Witter Reynolds back then. And so at Dean Witter, I started to learn about the business, and I didn't know anything. I had no inclination. It was a job, and so over time, though, there was a fondness that came about from watching people help people and take care of a very intimate part of their being.
Right.
Well, for me, I went from being an intern to a receptionist to a secretary, and then in 1992, I kind of got my break, and some advisors that I knew and had built a relationship with asked me if I would join them, and they would make me a financial advisor. So that's what happened.
That's great. Yeah. I know you mentioned 3 decades making you feel old, but it's just seasoned, right? Experienced.
Seasoned.
Yeah.
Yes. I appreciate that.
Yeah, of course. So like you mentioned, moving from large firms like Merrill Lynch and Barney to building SRM Private Wealth, obviously that was a significant transition, like you mentioned. So what motivated that move, and what did you want to do differently? What made you want to go that way?
Yeah. So after 16 years at Merrill, I had kind of a disagreement about how they wanted me to run my business. And the disagreement had to do with, we work with clients in a variety of different ways and in different parts of their lives. And we get involved in a bunch of things. And a lot of these guys have become friends of mine. And, we do a lot of things together. And I help them with a lot of different things, or try and help them, or one of the voices of that help. So Merrill really had an issue with, they called it over-servicing your client. And so they didn't really want me to get involved in things outside of the scope of Merrill Lynch. And I've been doing this 30 years, and I wasn't about to change the way that I've been doing it for 30 years, or trying to do it for 30 years. And so decided to leave at that point, and set up my own shop. And one of the things about setting up your own shop is you kind of have autonomy on what you can do within the regulations, obviously. And so we were able to put together a firm that, for me, I wanted to limit the amount of conflicts of interest. And I'll just give you one quickly on that. Is if you go to a firm that's owned by a bank, for example, and you ask for a mortgage, the mortgage that they have to show you, the advisor has to show you, is that of that one bank.
Okay.
So if I have to show you one of that one bank, then am I selling or am I advising?
Right.
Right. And so for me, I've always wanted to be an advisor, not a salesman. And so when we designed SRM, I wanted to have no banking conflicts. I wanted to have we are completely void of, or as close to void as possible of any conflicts whatsoever. So there's some natural things in there that I can't, that no one can get rid of. But the factual is that we have taken away all banking, all of those things, and it allows us to advise. And for that mortgage that I mentioned, I would go out and get 7 different bids, and I have no conflicts of interest on that point. And so, yeah, that's kind of what we've tried to do with SRM.
Got it. Right. Yeah, it's just wild to think about, them saying not to overservice your customer. When you think of a, financial advisor, you want that exact thing is to help the client out as much as possible. And that's what you look for in a, or someone who's going to advise you on something very important like financials, right? So I know you talk about it being a holistic approach to wealth, right? I think
Mhm.
that's what you talk about. So what does that actually look like in practice when you're working with, the ultra high net worth families? I know you gave us a little bit of an, example, but, what does it look like, the whole scope?
Yeah, each client is different, and we represent 38 families right now, and with those 38 families, everyone's got different things going on.
Hmm.
The we have people that have owned sports teams and lots of real estate and airplanes and family dynamics and all the things that you would think a family would have, right? And they might have it on another tier of wealth, but all in all, there's a lot of things that are very similar amongst families in general, from people that have $1 million to people that have $10 billion, and there's a lot of similarities in a lot of that. And then there's these one-offs as you get up the wealth chain of other situations that arise. So I find that for me, it's how do I advise in all these different areas, and how am I able to be one of the voices? Because we work with their attorneys and their accountants and all of that as well. So we're just one of those voices that are heard when they're going through some type of transaction.
Understood.
Yeah.
Yeah. So I want to backtrack a little bit because I want to talk a little bit about family offices because I think there's a lot of people who don't even know what family offices are. The
Hmm.
immediate reaction to when I'm talking to people about family offices, they think healthcare or dental offices, right? Family
Right.
offices. So can you break that down a little bit and explain what family offices, ultra high net worth families, individuals are?
Oh, yeah. So when people have a certain amount of wealth, I always say it's around a $500 million. The they might need some people to be full time looking over their monies and their investments and their ownership and whatever. And so they have people and paying their bills and doing the day to day stuff, but they have a staff that they've put together specifically for them. There's also something called multifamily offices, where you can have multiple families that go in at lower net worth and have a dedicated team to you. But a family office in general is just basically creating a corporation around your wealth, and they hire people internally to run that.
Does a multifamily office have to still like all the combination of them all still equate to about $500 million?
No, well, that's a good question. I don't know. I don't deal with many multifamily offices at all. I will tell you that anyone could theoretically put together a multifamily office. I could say that we have 38 families. We have a multifamily office. The reality is that when you have a family office, the nice thing about it is that I've got a set level of people that are doing things for me every single day, and I can monitor and stuff like that. With a multifamily office, it's normally an outside entity that is put together for multiple families, and families come and go out of that model. The problem with it is that you have let's say on a multifamily office, you have a CIO, a COO, you have an accountant internally, you have a lawyer internally, you have all these things internally. Um, but you've hired this outside group to do this. So the question I always have with that is that uh, how am I going to monitor the various parts of that group? And what if one of them's bad, or I don't like them, and now I've got this group, but one piece of it I'm now having to go. There's all those types of things that when you go into a structure like a multifamily office, it doesn't make much sense to me personally. I like when the various parts of my clients' advisors don't have anything to do with one another. And the reason for that is we're all overlooking each other. I'm always looking for those. I don't like as you can hear, I don't like the conflicts of interest. So I don't like when, I know the accountant or the attorney or we're buddies or whatever that looks like. Because then it takes away some of that. I can fire you at some point, or you better be doing a good job. Otherwise, we're going to be having conversations with the principals. Those are the types of things that we need to understand when you're looking at the difference between a family office, which is quite expensive, and then a multifamily office, or doing it virtually and creating just an advisor group around you.
So from a single family office perspective, you have a little bit more control of the logistics of it all.
Because they're internal and you can get rid of them at any point, and you still have your structure together.
Right, exactly.
Harder to do when it's an outside company.
Right. No, that makes sense. No, thanks for touching on that and kind of explaining that, because again, I'm very surprised at how many people don't understand or have an idea of what, the family offices are. And honestly, I have to say for myself, it wasn't very long ago when I learned about it as well, so I'm glad that you got to kind of break that down for them and help them understand that. So,
well, and to be fair, there's a lot of people that run around and set up family offices at much lower net worth, and the idea of having a family office is kind of a coup in itself. But the reality is that the expense of a real family office is quite great for what you're getting for your money. So I do for most people that we work with, we set up virtual family offices where they have advisors at different firms and doing different things. I'd rather do that.
Right. Yeah. I mean, and to have, 37 families? I believe 38. That's what you said. 38? Yeah, exactly. I mean, that's, you have to definitely have your ducks in a line, to be able to manage that many, especially if that high, net worth is incredible. Speaking of high net worth individuals, for like many athletes and entertainers, they experience rapid wealth early in their careers, right? So what are the biggest mistakes you see during that window, and how do you help clients avoid them?
That was a tough one. We do, outside of the 38 families, we have a practice of athletes and musicians primarily. So I'm a huge music guy. You can see the posters behind me. But a huge music guy. And, a lot of the people that we've come across are like 80s, 90s bands primarily. So when I get brought into stuff, it's normally we're fixing situations that should have been done right at the beginning of this. Athletes are the same way. I seem not to get them when they get their after their rookie contract, the big contract. I get them when they're on
second
their
and third.
last few $1 million. But we worked with a basketball team for a long time, which will go unnamed, but we worked with them for a long time, and we saw this issue many, many, many years ago, and it just seems like it's continuing through, even with all the education programs and all the other stuff out there. I think what the initial problem is that a $10 million contract is not a $10 million contract. I mean, not $10 million in your pocket.
Exactly.
So if you run the math on something like that real quick, is that if you have $10 million contract, let's just say, $2 million comes off the top right away. And that's for agent or manager, and business manager, lawyer, whatever. Then I pay taxes on the other $8 million. And at $8 million bucks, let's say it's, I don't know, 40% effective tax rate. So now I've gone from 8 million down to, what does that come out to be? 4.8 million. So now I've got 4.8. Then I go buy a home. Then I might buy my parents a home and I buy a car, and $4 million is a lot of money. Don't get me wrong, but when you're a athlete or a musician that has all of a sudden money in their pocket, it's hard not to want to go out and buy a nice place, right? So we have those issues, and then careers last between 2 to 4 years on average.
On average, right?
And we don't really think about that because we look at the Kobe's and the LeBrons and a lot of these guys that have had these wonderful long careers. The majority of the players are on the other side of that. So,
Right.
We deal with all these types of things, and then the difference between an athlete and a musician is an athlete, when they retire, how do they make money? Right? They may not have a vocation. They might have a college education, and they might have the vocation, but they don't necessarily have what that next step looks like. And maybe that hasn't really been planned out because they were going to have a 14-year career and everything was going to go great.
Right.
So when we deal with these types of ideas, when we deal with the concepts of an athlete, I got to figure out, when I normally come in, is now I got to figure out what that next step is going to be. How are they going to get through the next 30 years or 40 years of their life? And how much do they have left, and how long is that going to go at the current spending levels? So anyway, we kind of go through all that. Musicians are different. Musicians, back in the day would get, label contracts, and they would get a lot of that stuff. Nowadays, they really don't, or it's very small. And so then how are they going to make money? Those that have established and have music, there's publishing revenue and there's master revenue. And we have a lot of these different, I can make money off my merchandise. I can make all those types of things. So there's different revenue sources with music that could be ongoing for many, many, many years. But there's still mistakes that occur in that.
Yes.
They sell them off, they pay capital gains taxes, they pay their management, and then they end up with the net. So listen, a lot of these things are much more complicated, but I think the initial problem is the math on what I'm ending up with at the beginning or each year or however that works. And then secondarily to that is that my spending habits in regards to that.
Right.
So.
Trying to maintain that lifestyle when, obviously is not, cannot continue to do that for the long haul. Yeah.
That's right. It just doesn't sustain itself unless you have an income coming in like that forever.
Exactly.
But when the career's 2 or 4 years, how are you going to do that? So,
yeah, exactly. And I can see the difference between an athlete versus a musician. I'm not saying musicians could just go out and, sell out Madison Square Garden, but at the same time, they could probably go and do a few different shows. Athletes, they can't just go and be like, oh, I'm just going to go play a game real quick and get a check. It doesn't work that way.
No, true. So and I will tell you, the one thing that's interesting about music these days, from my perspective and what I've heard, is that a lot of the tours are actually losing money today. So as much as we think that they're, you got to really take away the Taylor Swifts of the world and, the Kanye and what Kanye did the other day. That's a whole nother level. The reality is when you're doing 5,000, 6,000 seat venues, and you're having to travel by bus and planes and all of that stuff. All that stuff, and then you have your crew, and all that stuff adds up. And a lot of these expenses have really gone up post-COVID. And so I don't know if there's old band from, I shouldn't say old band, but there was a band from that I just actually just saw in concert a couple of years ago. It was a band called Garbage. They came out and they said that they can't tour anymore. They can't afford it. So, a lot of those things is. A lot of those ideas was that bands could just go on tour. That's not playing out these days. So I don't know how that's going to work out going forward. But.
Right. Well, if you were to be able to get, work, I mean, I'm sure you have a little bit, but, I know you mentioned how you're dealing with people usually towards the end of their career. But if you were to, if an individual were to come into like a major liquidity event, or if it is athletes and musicians, what would be like a first financial decision that they should slow down and kind of think carefully about, to help set them up from a, early stage?
Yeah, we try and budget, right? So we put together future value numbers for everybody, everyone that's looking to retire or whatever. So, or is going to be living off this income, and looking at various rates of return, looking at a predetermined inflation rate of 3%, let's say, looking at what they could spend and then how long that money would last them. And then you have to update those numbers on an ongoing basis. But uh, to begin with is for them to understand what the net looks like, what that can produce without spending the principal, if he spends the principal or she spends the principal, what does that mean to the longer term plan and how much longer this money is going to last. So a lot of those things are based on the idea of looking at the numbers. Numbers are very clarifying and very non-emotional. So
Yes.
for me, when I look at the numbers, or I run the numbers, this is what it's going to tell me. Now they can come back and say, well, I want this, this, and this. And I'm like, okay, we can model that in. And then this is where it's going to happen at the end of the day. So, I don't, there can be argument all you want, and the numbers are not going to change and the rate of return is not going to change. And I can change it and increase the risk and try and do all that stuff. And hope to outperform. But yeah, that's kind of what we do.
Understood. Yeah. I mean, it's, make them, like, I really want this yacht, but okay, well, this is going to take a year off of your retirement, right?
Right. Right. Oh, and that's the debate. Oh, okay, you want that car, then we'll get you the car, but it's your money, but this is what it's going to do to your plan. So if that's what you want to do, then it is what it is, right?
Yes.
And
Yeah.
just understand that. So yeah, it's argue with me all you want. It's I'm not arguing.
Numbers are what,
It's
yeah, the
their
numbers
money.
are what they
So,
are.
but I'm just telling you, this is what's going to happen if this should happen. It's pretty
Yes,
simple.
exactly.
Yeah.
Right, right. No, exactly.
Yeah.
It takes the emotional aspect out of it from your standpoint,
Sure.
right? I mean, but for them, of course, then it probably upsets them.
No, that's right.
Yeah.
And I can tell them all day long, this is what the deal is, or to your point, is just like, I want that yacht. All right.
Get it. Yeah,
What do
go
you
ahead.
want from me?
But this is what happens. Yeah.
I can't do any more than show you what the numbers are.
Right.
Yeah.
Yeah, these are
So
the repercussions, right?
exactly.
Yeah.
Exactly.
No, that's great. So I want to shift gears a little bit because one of the hardest parts of, wealth management is often the family side of things, right? So
Mhm.
aligning values across generations. How do you help families have those conversations? Because it's got to be difficult, right? Because everybody has a different idea of what they want to do with it, moving down generations.
Yeah. Listen, it is a great conversation. And the concept I think we start off with was this concept of generational wealth. Generational wealth makes no sense to me. Um, Generational wealth is this, if I want to reduce my standard of living to then pass money on to the future generations so that they have an easier time of it. Some people want to do that. And some people will sacrifice everything about them today and their life today so that the next generation or the next generation has money going forward. The reality is that when you do the math on it, if I have 10 million bucks and I have two kids, if I die, right, $30 million goes to them approximately tax free, 70 million left, 35 goes to taxes. Now I have 48 million bucks divided by
Mm,
two. So now it's
yeah.
24 million each. And then they have two kids, and you keep going down that line of taxes, kids, division. And at the end of the day, there's an old saying in estate planning called shirt sleeves to shirt sleeves within 3 generations. So shirt sleeves to shirt sleeves within 3 generations just means that the first generation has to roll up their shirt sleeves and make the money. And by the third generation, they're rolling their shirt sleeves back up and having to make money again.
Uh-huh.
And that's just division and messed up stuff, right? So, the conversations that I have with a lot of people in regards to this it's always interesting to me to hear what their perspective is.
Hmm.
I come from a level on a personal level that, it's, I've given my kids every opportunity to do what they're going to do in the future. Their colleges, they're done. Now it's on them to do. And if I have money left over at the end of my time, then whenever that is, then that's what they'll get.
Hmm.
Other people want 100%. Other people say, I want zero to go to my kids, and I love my kids, but I've given everything away. So there's such a wide array of what that means to everybody, and we spend a lot of time on that. And then the kids themselves, our business, the reason that we have 38 families, we have about 600 accounts, but because it's multi-generational. So we do deal with the future generations of this money already. And so a lot of that is we work with them on the idea of no inheritance. I don't even want to deal with the word inheritance, because if I deal with the word inheritance, then what I'm doing is I'm assuming that the parents are going to die at a certain level and a certain wealth.
Hmm.
I would debate that all day long, because we don't know what that looks like. So the idea would be that they make themselves as productive as possible, and with planning on zero coming from that next generation. And it's not real until it happens.
Right.
It's like, I can't tell you how many times I've been hit on for, to plan something out for somebody, and it's based upon some liquidation event of a company in the future. And you're like, I don't even know what that means. How
Yeah.
do you
It's
even
almost
value
fictitious, right? Yeah.
something, right? Inheritance is the same way to me, right? Inheritance is something that could happen or may not happen. The parents
Right.
could blow the money. They could make a bad investment. They could just buy whatever they wanted to buy, and it's gone. So
Hmm.
how can I plan on what that means? So anyway, I'm belaboring the point, but that it's an extremely important conversation.
Yeah, exactly. And it makes a lot of sense because it's just like any parent, you should show your children, the value of a dollar, because at the end of the day, if you're giving them everything, the second you are gone, they're not going to know how to do it for themselves, right? And so if they plan to not have anything, then they're going to value that a whole lot more when it does get passed down to them, whether they know it or not, right?
That's exactly right, and that one's, especially with people with wealth. That's a really tough one, because a lot of the conversations that are, how do I keep my productivity? How do I keep that? I know I'm wealthy. We live in a nice area. I went to nice schools. My parents, we all have nice cars, and as a parent, you're trying to give your kids all this wonderful stuff, and stuff better than maybe you had when you were a kid. But on the flip side of that, does that take away from their appreciation of that? And for some, what's interesting is you can have two kids, and one of them, there's no appreciation for it because they're spoiled, and then the other one is extremely productive and doing wonderful things, right? And it's the same family, same everything. It's just different perspectives for the kids. So I do find that it really is a hit and miss in a way, and how the kids perceive the wealth and what it means to them. Because last point I'll make is that, I have 6 children. So when I have my kids telling me about their rich friend, I'm like, did they make the money or did their parents make the money? And
Yes.
that's a whole nother situation or another conversation that we have in regards to that, because there is this wonderful perception that because their parents are rich, that means they're rich. And I'm like, unless they have something set up, that's not true. And that's not necessarily true. And
Yes.
I've gone through this too many times to
Yeah.
not realize that.
E- Exactly. Well, you're also doing a great job because I believe a couple of your children of the 6, are working for you, right? One of them, and
Hmm.
then I think one of them might be on her pathway out. I'm not sure if that's still a thing from the last time we discussed it, but I'll let you kind of fill that in.
Yeah. So I have a son that just got out of the Marines, and he's working with me right now. And then I have a daughter who just graduated college, got a job at NASCAR. And so she's off to NASCAR for an internship for 10 weeks, and then she's going to grad school in Michigan. So very proud of both of them, and my other children, of course.
Yes, yes, absolutely.
Yeah.
Yeah, it's kind of funny that you mentioned, from one child could have an appreciation for it versus the other. It almost, and this is not for every family, of course, but it always seems like the older child has a little bit more of appreciation just because they had the younger siblings that they had to kind of divide the wealth with, and then you have the youngest child who ends up being, and I'm doing this to myself. I'm the youngest of 4, and then I have 5 children
Mhm.
myself, but it seems like the younger child always gets a little bit more spoiled, right? So they have a little bit less appreciation. And again, that's for every family depending on how you raise your kids, but it always seems like that seems to be the way it happens.
Yeah, and I would imagine the other thing is when the oldest you may not be at the same wealth level when the oldest is going through it. So the oldest
Exactly.
might remember and be raised a little bit differently when the wealth is not quite there, um, and the other ones get to see the majority of that over time because they're part of that growth of wealth, or the whatever event occurred. So
Yeah, they get
there's
to
many
reap the
reasons why.
benefits a
Yeah,
little bit. Yeah.
yeah,
Yeah, exactly. No, that's great. But you also play a role in, connecting clients with charitable causes, right? That's a big
Mhm.
part of it. So, how do you help clients think about philanthropy as part of their overall legacy?
Yeah. It, when I started doing philanthropy really in uh, a larger scale, back in 2008, I was introduced to a wonderful lady, Donna Karen. Donna Karen is a wonderful fashion designer. DKNY is the brand that most people know. So I was introduced to her, and she was doing things in Haiti at the time. And we brought together at that time, it was her and the Clinton Foundation and Sean Penn, and who's got something called JPHRO, and a lady by the name of Petra Nemkova. Um, and they all worked together to kind of bring things to the Haitians that had gone through the horrible event there. And so got involved in that, and I was really kind of hyped on finally getting involved in that part of people's estates. And so, people come from two different beings, right? There's some very wealthy people that I know that are very non-charitable, and that's their prerogative. I have some people that don't have as much net worth and or anywhere close, and are very charitable and want to kind of have that as their legacy. And so, working with each one of them, we're working on things that have unfortunately afflicted either them or someone in their family, some disease of some sort. Um, and they'll come to me and they'll say, hey, listen, I want to give some money to this. And so then we'll work with the charities. I'll call the charities. We'll work with them on how they're going to give the money and what they're interested in giving the money into. And let's say it's a particular project or part of the organization or whatever it may be. And then on the second side of that, we've I think I've done 36 or 37 rock concerts for charities over the years
Wow.
here in Los Angeles. And that was a wonderful thing because I got to see I got to see some bands that I always wanted to see. And they were doing good for somebody, right? They were raising money for some type of charity. And so yeah, we've been very fortunate in being involved in that part of it, for those that are interested in that part of it. Yeah, I love getting involved in that kind of stuff because there's so much good that can come out of, or potential good that can come out of that. So
Yeah. Is it typically with the families that you advise, has it been more on the lines of them asking you what they should work on when it comes to foundations and philanthropy, or is it more along the lines of them kind of coming to you? Like, is there a balance? Is it kind of equal, or is it more?
it just depends on the client.
Okay.
Yeah, the one thing that I get asked a lot is that what's the difference between wealth and athletes? What's the wealth of musicians? What's the wealth of high net worth or ultra high
Yes.
net worth? Right? We're all human beings at the bottom baseline of this whole thing, right?
Hmm.
So the athlete that's wonderful on screen or on television or when you go see him live is awesome, but as a human being, that's where I kind of come in. I know these guys on a personal
Personal
level,
level.
and a very intimate level in some cases. But so that's kind of where we start off. Is there's not much differential when you get through who they are, who they think they are in some cases, and and we get to know those people as human beings, and there's not much differential there. People make the same type of mistakes, make the same type of decisions. So that's kind of where we start off. As far as people coming to us, it just depends on the client. A lot of these guys are very, as I said, very charitable and want to get involved, and they'll come to me to help me vet or figure out how they're going to give their money, but they want to give money to a specific organization or whatever. Um, so all these things are very important to understand just of the client themselves. So.
Right. How long have some of these clients been with you? And is there going to be a cap? I mean, if they just keep flowing in, or is there a time where you're going to be like, okay, I can't take anymore?
Great question.
Yeah.
So I have my first client ever still.
Yeah.
Um,
Wow.
so she's been with me, her husband and she were, I made a cold call during training out of Weehawken, New Jersey in 1991, December of 91. And she's still with me. So actually, we belong to the same golf course, and so I see her when she plays a couple days, and she's 92 now, and she plays a couple days a week.
Well, that's awesome.
It's amazing.
Yeah.
So and we've had clients that have stayed for short periods of time, and I wasn't their cup of tea, and then I have other clients that have been with me forever, and then it becomes this multi-generational, naturally, just a multi-generational vertically. And then we're also horizontal. So we're at the cousins and the aunts, the
Oh,
uncles, the
wow.
cousins,
Yeah.
all that. And we kind so a client of mine many years ago told me that I was like an heirloom that he passes down generation after generation. So it's
I love that.
yeah, yeah. So and that's what I wanted to design. We a lot of financial advisors, one of the big things that happens is they don't build a relationship with the next generation, and they really don't advise the family, right?
Hmm.
The family's different than just the individuals. And so over time, they'll lose those assets as the inheritances occur. Um, I know which one that's going to happen with me, and because they have other relationships on the outside, and I know the ones that are going to stay on for a long, long time. So.
Hmm. Yeah, I can only imagine how much of a balance it has to be from the personal standpoint versus the numbers, right? So I can see some people, why they probably lose clients is because they either get too emotional, they just, or only solely rely on the numbers, and then it almost doesn't feel like the person's advice. It's just, there's no personal, relationship there. And that's going to really drive them to trust you, right? And so I can see that you have to have that big balance when it comes to working with these families.
Yeah, a point I'll make on that is that there's a lot of advisors that are salespeople, and they're good salespeople. As far as advising, that's another story. And they might think they're advising, and they might be running a financial plan or a retirement plan, but at the end of the day, they're going to, you know, um, show products or whatever it may be that, you know, might there might be some conflict there.
Right, right.
Um, there's also advisors that don't run the numbers, right? And or don't know how to, and or rely on prepackaged software to do it, and it's not the personal side of it. And so there, it depends on the type of advisor and what you're looking for. I get brought back to the same idea that if you look at an investment and you look at a trade, those are two different things. Like when I watch CNBC, or when I watch whatever ubiquitous platform, television platform there is, um, there's a lot to talk about. Buying a stock today and selling it tomorrow. That's a trade.
Right.
An investment is long, long term. It's
Yes.
not these short term little. It's up 2% today. I'm going to make 2%. If you want to trade, that's your thing. I'm not that guy.
Right.
So people come to me primarily for maintaining their wealth and getting a rate of return higher than they can get elsewhere. Um, but it's not, the people don't come to me to get these, 50% up and 50% down days.
Yeah,
That's not
exactly.
me at all.
Much
So.
much less volatile, right? Yeah.
There's no, I have a client that I see, we play golf together, and he was telling me, our meeting is basically, how we doing? And I said, well, interest rates are up, so you're down a little bit. And he goes, are we going to be okay? And I said, yes. And he goes, okay, let's go play some golf. And that's our that's our big account
That's all I
review.
wanted to hear.
That's
Yeah.
all he wants to know. And we've been doing this for 27 years now. You know, that's these guys, you build this trust over time, and as I said, I'm being overseen by their accountants and their attorneys, and there's a lot of people that are overseeing this, not the principal that I'm playing golf with, but
Yeah.
he knows that if I say yes, we're fine, and then the accountant comes back and says, what's he doing, that would
Mhm.
be an issue. So we,
Yeah.
we kind of stay just knowing that we're being overseen by a lot of people.
Yeah, exactly.
Yeah.
Staying transparent, right? Which is very
Exactly.
important, right?
Exactly.
Yeah. I love it, Richard. Well, I really do appreciate you joining and speaking with me today and the listeners. I do want to ask, for anyone who's listening and they want to learn more about your work, what you're doing at SRM, Private Wealth, or also stay connected with you, what's the best way for them to do so?
Yeah, LinkedIn's always great. Richard McWhorter, it's spelled McWhorter. And I have a website, SRM, Sam Robert Mary, privatewealth.com.
Amazing. Yeah, I'll make sure those are in the show notes, make it a little bit easier on the
Thank you.
listeners as well. And I do really appreciate you joining today, Richard, and spending time with me and the listeners and sharing everything you're doing because it truly is amazing.
Thank you. I appreciate it, Dylan.